Hi, everybody. Today is September 21st, almost the vernal equinox. The Fed raised rates 0.75% today to 3 and 3.25. Prime rate went to 6.5, and the market did a bunch of 100-handle moves before ending down 72 at 3,800. For those people who like round figures, I'm joined by semi-regular Peter McEwen, and our new favorite regular is Steve Hammer. Of HFTAlert, without the S, everybody. It's HFTAlert, singular. And without further ado, gentlemen, happy Wednesday, Misfits. Mr. Hammer, I don't know, did you trade today? You were busy with something.
Unfortunately, I was busy today. I love days like this. So
yeah. And Peter, you didn't trade today, right?
I didn't trade this Fed day. I typically do, but
right.
And you have to be ready to manage a trade, and I was a little too distracted, so I decided not.
Which is a very good idea, Peter. If you can't devote 100% of your attention, you shouldn't be trading.
So what's interesting on a Fed day is that the HFT Alerts program, which Steve Hammer created and runs, and has all the data around today. So why don't we give him the opportunity to show us what went down today? So without further ado, again, here's Steve Hammer.
Let's see if I can get this thing to share, because we tested this.
It was pretty busy today.
So you don't see it, do you? There. Do you see it now?
No, we can get Matt, hopefully, or somebody to help. But
hold on.
Steve's program, to give a quick sort of, here we go, is comprised of many things, one of which shows the activity in a very high frequency level, as well as accumulative data in the dark pools for names.
So let's look at the first monitor, if I can bring it in. This is remote, which is why it's kind of doing what it's doing.
Right, if everybody is curious, Steve's house got flooded while he was on vacation. Happy vacation. So he's now having to remote in, which is why it's a little bit clunky. So please forgive us.
So we can see that starting the day, activity was pretty shallow. This section here on the right shows the number of issues in the programs, and of course how many are run are shown on another scale. But you can see that here's the 2 o'clock, and first there were a group of cell programs, and then about 2:30, which is when the press conference started, you can see that the buy programs took over and led the balance the rest of the day. There were a total of 1,018 programs, 535 of them were buy programs, 480 of them were sell programs.
That's a lot, isn't it?
We had, yeah, that's a very active day. We had 31 pure capper buys and 12 pure capper sells, 67 auxiliary capper buys, and 54 sells. So you can see that the programs, what cappers are large programs that have over 350 issues in them. And the auxiliary ones are ones where there are multiple programs that are part of the same group of programs. And
is a capper buy something that just goes off at once, or does it run over a multitude of seconds?
Well, let's take a look at them. Let's scroll back to the beginning of the day. So here's 10 o'clock. I'll just scroll up and we'll look for when they're colored blue, that light blue, we want to, what am I doing back here at 2 o'clock?
Nothing happened between 10 and 2. See that?
Oh, yeah, I had it off.
Oh, you did? Okay.
Yeah. No, that's probably not true. No, that's how many programs there were. It was on from 10 o'clock on. Otherwise, if there would be a break in this chart right here. So there was essentially nothing going on prior to 2 o'clock. You know, the first program of the day hit at 10 o'clock. And of course, the news comes out and programs run. So you can see initially there were a bunch of sells. So let's find a cap or buy program.
Would you be 230 or something?
Here we go. Here's one right here at 210. So if we click on that and come into this chart over here, graphic, these are the symbols that were in it. So, and these are colored if they're over 100 trades for those symbols in that second. And you can see that number goes down to 2 or 1 or 0 that are just quoted. But you can see there's not that many issues in that program of any consequence in terms of number of trades. It was just a lot of programs, a lot of symbols being hit, 298. And that was a sell program. So let's go find another capper. When it's a kind of a boring day, when there's very little going on, there's no news, and prices are trending in one direction or trending in another, let's say they're going up and you get a cap or buy program, that typically marks the high for that particular run. And conversely, at a low, especially if you see price going vertically down and you get a cap or buy program, or excuse me, a cap or sell program, then that's also a reversal indication. A lot of people would see this is a big sell program, I better short it. No, it's usually that culminates a move. That's why we call them cappers. Some people have stolen that term from us, but that's why we call them capper. I've used that term for decades.
Consider it a compliment if someone's lifting your stuff.
Yeah, I know. Was it plagiarism is the highest form of...
Right. And I think Martha said that frequently.
Yeah. So you can see at 231, 27, 28, 29, and 30, these programs are all related. So this one targeted 290 issues, and look at all the individual stocks. All right, so that other one was basically some kind of just who knows what, but here, when you see this many individual stocks involved in a program, well, that's a portfolio. And here, a second later is another one. Here's also lots of issues. Not so much.
Literally a second later.
Yeah. And then here's another even smaller. So the bulk of the trades where they had large number of trades in symbols, right? And this one peaked out at probably SPY at the top. No, Apple, 581 trades in that second. And if we went to the bottom of this list, you can see they're down to 1. But if you come to the last one here, it has the least number. Look, and very few individual stocks over 100.
So that's the mop-up version of it.
Yeah. So remember, when these portfolios, this is really important. Now, here's a whole bunch of cap or buys. Look how many. So what causes this is not manipulation or an attempt to gimmick retail. What this is a portfolio. Back in the day, when there were individual traders, you'd have a portfolio like Peter Lynch's Magellan Fund, for example, the most successful mutual fund, and that's what kind of cut my teeth on that kind of style of investing, where you build portfolios of great companies, and it's not on the basis of what their stock charts are, it's on the basis of what their businesses are.
Kind of put Fidelity on the map, right? Back in the 80s.
It absolutely put Fidelity on the map, and now they've got trillions of dollars.
Right. Remember, he had incredible returns year after year, didn't he?
Well, it's from 1981 onward, the market has gone up and made new highs consistently over and over and over again because our economy grows.
Mm-hmm.
So, but back to this point with this.
Sorry.
So there would be the portfolio manager would have his portfolio, and he would manage that, or she would manage that portfolio on the basis of various metrics, not on the basis of identifying hot stocks. And those metrics would include allocations that were fixed percentages. And as stock prices go up, as a company's value goes up, those percentages go up. So they have to sell little bits of the stock to bring their percentages back down. And when positions that are in their portfolio go down in price, those allocations shrink. And so they have to buy shares of those companies to bring their percentages back up. So they're always selling high and buying low.
And it's not a strategic thing. It's just a risk parity or mathematical thing.
It's keeping the metrics in their portfolios consistent. And that used to be done by room full of people. Some guy would be, or some person would be on the A's. I hate that. Anyway, all the guys I was working with, they were guys. So now those metrics are simply programmed into the computer, and the computer order entry system is connected directly to an exchange. And instead of an individual trader getting the order to, here's a list of stocks you need to buy and how many shares, and here's the ones you need for sales and how many shares, and let me know when they're done. That's what I would tell my people in portfolio, and when we were managing Cyberfund, and you'd come back a couple hours later and see if it was done. Well, now it's done by the computer, not because the computer has been programmed to figure out what the markets are going to do. Now they're keeping their allocations where they need to be. So those order entry systems get put into these kinds of programs, and they get done very, very quickly. I mean, look, all these stocks that were bought and sold between 4:33, 23, over these 3 seconds. When people say the market isn't efficient, they don't know what they're talking about. To run this many transactions when I was a portfolio manager would have taken an hour, and we would have had tremendous slippage, because you got to, every single trade you got to call up a wholesaler.
That's why the floor memberships were worth so much money, because of that slippage.
So now that all is done by machines, and you can see this is the functional result of just how incredibly efficient our markets are, and how so much better for the typical investor and the typical trader. I could never trade ranges the way we teach our users and our people in trading school to trade ranges today. Back when I was a portfolio manager, there just simply wasn't enough liquidity.
Do you think that's a function of there's nothing on the top of book, or do you think that's a function of the fact that there's potential outcomes are so much greater? Why are the ranges considerably larger?
They're not considerably larger. They're considerably easier to trade. They're actually smaller than what they were. Stocks that were trading at 3/8, 5/8.
Right. The bid ask is of course micro pennies.
Yeah, 5 decimal points. Right, got to make 100,000 trades to make 1 penny. Right, a human being wouldn't do that. A computer that's running an order that's at the exchanges, running like the computers at what's the name of that guy?
Citadel.
No, well, them too, but anyway, markets are less volatile today than they were when I was in my mid to late 20s and trading OTC stocks. A lot.
But I will tell you that when I first started on the floor in 1980, I asked Donnie Stott. He was selling stock futures with the Dow up 20 points.
Yeah.
And I asked him, what are you doing? And he says the Dow's never been up more than 20 points.
Well, man, when it was at 700.
Right, it was at 600 at the time.
Right. It's the same percentage. The number of points don't matter. It's the percentage that does. Percentages are percentages are percentages.
For sure. Like at the 08 lows, we had a 10% rally in an hour. The market was trading 600 and we rallied 60 handles.
So here's the liquidity accumulator. We can see right here is the Fed announcement, and you can see that from that point to this point, the accumulator was higher.
For people who are watching, this is the dark pools?
No, these are dark pools. They were selling.
Okay. And what the accumulator is?
And the algos here, these are machine-based trades. They basically just move with price.
Right.
And this move up at the end is simply short covering people going home flat. But
So for people watching, these are parts of the HFTAlert software program.
yeah, the suite is comprised of the delineator, which is right there, the accumulators, which are here, and we've been running these since 1998, and some people tried to.
I mean, I think that as a user and someone who's become 100% better of a trader, whatever that means, from just learning from Steve, you don't need to carry around this dystopian narrative of gamma positioning and a lot of this other sort of structural positioning that a lot of our colleagues carry, because you're just mainlining the liquidity, the delineator, and you're looking at the actual transactions themselves. So I think it illustrates and motivates you to trade setups without backfilling some sort of fantasy about why and what you're doing in the market. So I think I was just kind of giving a maybe a little more subjective perspective on what Steve was just illustrating for the audience.
Steve, is it right to say that this having the structure of the software to lean on removes a lot of the emotionality?
Well, that's the thing. Any decision that you make that's based on emotion will be the wrong decision at the precise correct time. So what we teach our users are a very simple set of skills and a methodology that they can repeat over and over and over again with the same decision-making process.
Do people show up at school being fairly traumatized?
Not that I've seen, no.
Okay, from the markets, I'm saying, right? Like people just, it's like they wash up on the shore of HFTAlert having tried to read the tape or, whatever it is, maybe, trade on gut feel.
I mean, if you show up to Steve traumatized, which I have, he'll ask you a simple question, and it's not about market psychology. It's about, are you trading setups that I've illustrated for you? And oftentimes you're not. You're being scared out of a position by probably more primitive drives than actually paying attention to the market action and what the software is telling you. So I think clipping that feedback loop of what you see and your whatever somatic response, what your body's doing, and then you create a story to provide a bias, it kind of cuts all that out. That was like a major revelation for me, was that I don't have to continue some sort of like neurotic cycle that underlies a lot of my trading. You could just look at what's happening in the market as it's happening.
And another thing was the ability to average if you were early.
Yeah, management of a trade is key, but we don't get into that until toward the end of the second week. The first week in trading school is a deprogramming. Most people believe that trading is a predictive process, and I'll show you that it's not. It's a reactive process. It's like driving in a car. A lot of people, if they drove their car the way they managed their trades, they'd end up killing themselves and most of the people around them. But I've been doing this for this is the 44th year.
Yeah.
I've been living at the stock market, and I've learned in 13 years of running HFTAlert how to teach people how to make money. And
you do that quite well, actually.
And once we teach them this basic skill set, decision-making set, and show them how that if they're not doing the setup today, then the setup will be there tomorrow, and the day after that, and the day after that. It's always a setup. You simply wait for the setup to present to you. And the second week is we teach people how to identify the setups, because when we all look at these wavy lines, let's go back to this chart here.
Yeah, can't I surf the market?
No. No.
Can't I feel and trade?
All right, let's see if this works. Okay, I think.
Right? What was it? We don't surf stock prices, I think is the term.
Yeah, we're not surfing stock prices. So most people would look at this chart and see the wavy lines and not know, really would think, okay, well, if it's going this way, the market should come back up to it. If it's going down, it should go down that way. So the answer to that is kind of yes and no. So divergent ranges trade out, and a divergent range, this line here, this accumulator line, does not predict price. It identifies which, remember, trading is a reactive process. So when we teach people first how to identify the ranges, then when we get trade setups based on divergence, which is what the trade type number ones for the SPY 75 program, then they can learn to recognize, yeah, here's divergence. Well, where does the divergence begin? Well, you got to find the point at which time and price diverge, and from that level, you have a divergent range. Whether it trades that range out is irrelevant, and what is relevant is whether or not we are going to attempt that trade, and that's what the delineator tells us. The delineator tells us when and in what direction to seek setups. So that process is disciplined, and if people stick to the discipline and wait for the specific trade types, we have like 6 different trade types, and people start with trade type number ones, which are divergent range trade setups, and the trade type number twos, which are the easiest. The SPY 75, what we call by the book, has 3 simple requirements, and if all 3 simple requirements are met, then we have a long trade or a short trade based on the cycle origination, and it traded for a specific amount, and the delineator tells us when we should be trading that and when we shouldn't be. We don't try to trade every single up and down in the market. We only try to trade certain ups and downs in the market.
I have a quick question. The profit objectives have been a major factor in determining your entries. In other words, you can't enter unless you have a reasonable objective for a profit. Who thought of that?
Well, it's the way I've been trading, the way every range trader has been trading for 100+ years.
Yeah, that's genius.
Well, when you're driving a car, for example, and you know that you've got 1 mile that you need to exit the freeway, and you're in lane number 4 and you got to get to lane number 1. So you've got to go across 3 different lanes, and you've got 1 mile to do it, and you're traveling 45 miles an hour. So you got a little more than a minute to make that series of maneuvers and get off the freeway. So if you've been driving a car for any period of time, you're going to be looking over your right shoulder and looking in your rear view mirrors. And when there's a space available, you're either going to slow down and merge into it or speed up and merge into it. And you're going to do that again and again until you get off the freeway. When you first start driving, that experience is probably the most terrifying experience in driving. And I'm not surprised a lot of younger people today would rather have someone else drive the car. But when teaching people trading setups is very similar to that. And it's the repetitive nature of our methodology that is what creates the success, because we learn by doing. And when there's risk involved, in this case, when you're driving a car, your life is at stake. When you're making a trade, only your money is at stake. It's much, obviously, lesser risk. So the fact that these setups originate over and over and over again, it's that repetitive nature. So after going through the trading school and knowing what these colors mean, what these arrows mean, what these funny looking shapes mean, because every single thing that you saw, all those colors, they each mean something specific, and some of them are kind of complex because they're a relationship that they're showing you, as opposed to simply a data point. There are multiple data points in a decision process. So they see that, and after about a month, they get real good at 2 or 3 of them, and then they start noticing these other setups, reversal bar setups. And there's the swing trades on secondary that people are successful with only if they've become confident in these short-term trades.
Isn't it strange? Most people, when they want to learn how to trade, they want the answer. You're like, what's the answer? What's the answer? What's the answer? And your process is much more of a discipline rather than the answer.
We have a set of tools and a discipline on how to use them, a methodology to use them, just like any other kinds of tools.
Right.
George Gilder, back in the 80s, had this notion called was it singularity or yeah, I think so. And it's been a while since I read it. But he thought, this is back in 1983 or so, right? When there were still CPM DOS machines that, big giant 5 1/4-inch floppy disks, and the only programs you had were WordStar and SuperCalc, word processor typewriter and a calculator.
Accelerate, Bunker Ramos.
Right.
There was still paper tape on the floor of the stock exchange.
Yeah, I learned how to read a paper tape. Anyway, he said that when computer technology gets good enough, sophisticated enough, that we would utilize technology to leverage our brains the same way as early man utilized simple tools like the lever, the wheel, the inclined plane, and the pulley to magnify their physical strength. And so everything that I learned from 1978 to 1998, Jeff Donovan and I programmed into the delineator and the accumulator. And from that point forward, I've continued to work with it and see things in it that I didn't see when we created it. And if you go back to the journal archives back to 2009, you can see that we were using it in a similar fashion, but not as polished as it is now. And I'll tell you something, it's really a thing of beauty. And so many of our trading school students, the ones that stay on as subscribers and join our community and make money with other people, the people that go through the schools that don't get our software and don't become part of our community, they still write to me and they say how I've changed their perspective. I've made them more successful and less cynical about the market and have created so much more opportunity for them.
Well, think about it. You're providing the information that's irrefutable.
And it provides a foundation for people for the balance of their lives. I mean, a lot of our viewers here are 25 and 30 years old, 35, they're just starting on their careers. And the amount of potential opportunity for developing your own portfolios over time of millions of dollars, just starting. I started with $10,000. So there are hundreds, thousands, millions of people have started with small amounts of money. People don't realize, young people, including me when I was younger, don't realize,
including me,
the incredible value that time has to you. And whenever a minute goes by, that's a minute that's gone. It's gone for good. And if you manage a portfolio and use our zero cost strategy and build portfolios from development stage companies and emerging growth industries and consistently do that, you're going to end up with very large portfolios by the time you're 50. And
so, I hate to interrupt, but before we lose the topic, how many people have been through the school?
Altogether, how many have I trained since the beginning?
Yeah, how many?
1,000, 6,000, I think is how many users we've had over the years.
God.
I'm not sure. I haven't looked at it lately. In terms of trading schools, it's probably a little under 1,000 now because we only allow 30 students. We had a session I think 2 sessions ago, we had 45. And it was just too many people. We spend a lot of time. John, Indy, and Eric, the Norseman, you guys call him, and Nico, and the other people in the chat rooms, they really spend a great deal of time with people explaining things and setting them straight, because most of the questions come from way too complex of a perspective, and I always have to push people back to, let's get back to the basics. And I've always found, and I've said this many times, is that people are will easily accept a complex answer to a simple question, but they cannot accept a simple answer to a complex one. And trading is a very simple thing if you, except for swing trades, you know, on our range trades, there are trade type 2s or reversal bar trades, or trade type RBs. For those trades, not for other trades, but for those trades, you know, it's in and out. And if there aren't one of those setups today, there'll be one tomorrow.
I mean,
And all they
fading,
have,
right? The vertical stuff trades out is another simple concept that works time and time again. Beautiful, beautiful stuff. How long is the training course?
so the course goes for 4 full weeks. The first week is the first 5 days. You learn all the fundamentals. We don't talk about really trading much at all, though we'll probably see some setups.
And is it all day?
It starts at 8:45 a.m. Eastern time, so 45 minutes before the market opens. And people should be in the chat room until about 11:30 to noon for the first 5 days. Where you'll want to spend more time is in the end of the second week and then to the third week, when we're watching the market actually in real time, because that's the key. First, we tell people what the fundamentals are. We tell them what it is you're supposed to be looking for. We explain to them what all the things are on our charts. And then from that point forward, we introduce the first trade type, and we learn how to identify divergence. And so that means we have to watch that 1 minute chart all day. And as the day goes forward, we draw out the ranges, because if I show a chart and point to it, and I have 10 people look at it, 10 people are going to see something different. Every one of them is going to see something different.
Why is that?
It's just our perceptions. It's why art is an amazing thing, because some guy paints a painting and we look at it and
Music.
it means, you know, a multitude of things to multitudes of people.
People, right? It's very strange.
It's beautiful. It's a beautiful thing.
It is.
And then in the third week, they get the full software, the full real-time software. And we don't give that to them initially. We look at slightly delayed web charts, because if I gave everybody the tools right away, they're going to be busy pushing the buttons and changing the colors and doing all this other stuff and not paying attention. And if they don't pay attention, then the Mother Superior comes and issues a blow.
Have people called you a tough teacher?
Yeah, I'm your quintessential baby boom professor. So I spare the rod, spoil the child.
I would say you have a rep as someone who is not suffer fools.
No, I don't coddle him.
He reminds me of old samurai movies where the master always comes up behind the student and like whacks him with the stick when they're not paying attention. At first, it feels like you're never doing anything right, and I think you're not. But he doesn't coddle you. It doesn't have that millennial feel where you get a trophy for trying. That's for sure.
There are people that get Fs. And I will also say that some people, after a couple of chat or phone calls with them, I tell them, your personality is not suited. You should go find a good money manager and put your money with them, or buy mutual funds and let someone else manage your money for the long term. Because
quick question to Peter. Peter, do you have students? Have you ever told them to go find somebody else?
Meditation students or
Yeah.
my college students? Yeah. Oh yeah, of course, definitely. You have to be discriminating about someone's innate commitment to their own growth. And I'm not going to waste my time if they're not going to kind of energize the interaction and also invest in themselves in a specific field.
And that's the key. Yeah. That's the key. People must want to make an investment in themselves.
I want Steve to not necessarily be critical. Well, be critical in a he wants me to make money. That's why I'm there to trade. I'm not there to like it's a video game or something. I'm there to get better at it. And I probably have a harder time with the emotional regulation component of it, but I think that has to do with maybe generational things and the fact that I didn't come up through the ranks of very serious portfolio managers who know the business. So some of us have different areas to work on that we can't take for granted, and we're learning at light speed sort of how to, you know, pull our shit together. And if we're going to be aggressive, don't be gun shy in this market. You're going to get plowed.
Think about this, that Steve was saying that every second is wasted is a second wasted. So if that's the point that we're trying to get through or cross or have to work in that environment, then coddling or being nice is a luxury that time won't let us afford.
And our number one goal is to make people self-reliant. And the faster we can make people self-reliant, the more successful they are going to become. And so the methods I use to encourage people and motivate people, teach people, those are the things that have resulted in hundreds of people becoming self-reliant and successful, and that's better for themselves and their families and their futures. And
there's definitely, you know, if you want a friend, get a dog. There's a tough love element that runs through this business.
Yeah, well, I'm not all that bad. And now we have a whole new group of people. The team that St. Lucie is putting together has got me really excited. I was just telling my wife yesterday, when all of this, you know, I go on a vacation for the first time in like 2 years. And we come back and our house is destroyed and have to deal with all of that. And I just was so thankful that St. Lucie people have, or it's just such quality people, and have really taken over. And I started reading the journal today. Juan's doing an incredible job, unbelievable job. And he's learning something new every day. He had a good time with the market today, I'll tell you.
Do you think you'll be able to step away?
I'm sorry?
Will you be able to step away? You've been at it a long time.
Yeah, well, that's there are other areas that we want to grow the business as well, so that all of this that we built provide a foundation and new products over the coming years. I'm very, very excited about that. It's going to make a big future for everybody at St. Lucie.
Yeah, the Lucie crew will steward this thing unbelievable. They're all complete professionals.
Totally. And Charlie Bathgate, he is a king.
Mm-hmm.
He's Mr. I was telling my wife, he's being CFO-ish.
Well, let's talk about those stock names, right? With this January portfolio, Pulse came out today. How do people find out about Pulse?
So Pulse had an interesting, let's share the screen again. Here, how do I bring up a browser here on this thing? Whoops.
And what do you do to keep yourself alert? What a great line.
Oh, you want to know what I do?
Yeah, what do you do? Do you take a cold shower?
Hydration multiplier.
Okay.
Have you heard about this stuff?
Peter, that's up to Peter.
Liquid IV. This stuff is incredible. This is my trainer showed me this. It's you take one of these packages and you pour it into 16 ounces of water, which happens to be exactly the size of a typical water thing.
Right.
And then you drink it down in about 3 minutes. And then you wait about 7 minutes, I guess. And you will feel such a powerful rush. It just super hydrates your cell. If you're feeling a little tired, if you're a little cranky, if you're suffering from some delusions of grandeur, drink some of this.
Got it.
It's unbelievable. And you don't drink it after you exercise, you drink it before. And you can't see what this does to your stamina. So if you're in a trade and it's going against you, down a liquid IV, wait 7 minutes, do 20 push-ups, and you're going to be a Superman.
Are you still going to the gym?
Steve, are you sponsored?
And hey,
Zero.
what do you,
There are thousands watching right now.
right? And what is your workout routine at the gym? I want to know.
Then I take these.
Sure you do.
And then I sneeze about 5 times.
For real,
the-
what do you do at the gym?
Well, I'm
Quickly.
supposed to go in 2 times a week, but I haven't been there for 2 weeks. I'm supposed to get there tomorrow. I'm just too busy trying to find a place for my wife and I to live for the next several months.
Yeah, you're forgiven for sure. Oh, for everybody who's watching, Steve went on vacation to Cape Cod and came home to his house having a broken pipe, which had been running for 4 days.
Apparently.
I also
And-
want to say that using HFT software, enough about Steve,
Thank
that
Can I get some water now?
I started doing 200
Yes.
push-ups a day because when you're waiting for a trade to resolve to your limit order, you just do push-ups to ventilate the adrenaline or whatever you're going through it. I never was a push-up person until Steve always touts like you should just be doing push-ups if you're stressed. And it actually works pretty well. It gets you fit.
So for people who are watching, there is a community that is in a chat room, or a bunch of chat rooms actually, that Steve and other people now from St. Lucie also host. And so they have different flavors of trading for different types of people. There are longer term perspectives, shorter term perspectives, people who like to buy big bash down stocks. And it's a very eclectic group. It does not suffer from any sort of periscope thinking. Is that right, Steven?
This is true. We are all focused on one thing, and that's to make ourselves and everybody around us successful, self-reliant. There's a lot of Carlos and Sinan in the chat rooms that are into individual issues, and many people spend their time looking at fundamentals and will post the results of what they do. We're still struggling with the January effect. The portfolio has turned into a.
Oh, right. We were going to talk about that.
I learned a long time ago that portfolios are the result of what's left of all of your bad trades.
It's like Thanksgiving.
I won't, unless a company's lost their ability to fund themselves or are in a market that is no longer vibrant, no longer growing. When you get stocks like Pulse, for example, that we traded from 6 or 7 to 40 and bought it all back around 14, and now it's under $2, even though they've got close to 250 million, I think now in accumulated investment in their company. And the owner of the company, Bob Dugan, is an extremely successful entrepreneur, made billions and billions of dollars off 2 companies. Both started. One company started at $3.50. The other one started at 14, went to 75 cents, and 7 years later was $262.50 and is now ABBV. And this gets back to this growth investing theme in emergent technology companies. And it's those kinds of companies. And if you learn, yes, they're high risk, high reward, of course, but you take the risk to zero by trading them, by using the methodologies that we teach people to trade SPY and QQQ, they can use to trade any symbol. And these stocks love to go vertical. And when a stock goes vertical is when we exit. If we buy position a company and it doubles and we like what this company is doing and they've got sufficient funding and all the various checkpoints that we tell people about, which are very simple, then you sell half the position. Now you have half the position at zero cost, costs you nothing. It's pure profit, and you have your original investment again. You go out and do it again. And if you're 25 years old and got 10 or 20,000 bucks, you can find a dozen companies like this. And if you stick to them when they go vertical, when people first start learning about them, because people will pay up for what they don't understand and they demand a discount for what they do. And that's why value stocks have very low valuations and growth stocks have very high valuations. And growth stocks turn into value stocks when their markets are saturated. Every single value stock that's out there, which are boring companies compared to emerging growth companies, like companies in the quantum computing space, they started at points in time when they were the emerging growth company.
Like McDonald's, right? And McDonald's in the beginning was a growth company. Then there's one on every corner, or a Starbucks, and you can't really grow anymore at that, right?
Until they start some other kind of food.
Right. So the three stocks that you have mentioned was Pulse, and then there was D-Wave and Rigetti.
Right, and then there's IONQ, which was the first one. So that one, for example, if you look at let's go get IONQ chart here. Hold on.
Okay. Thanks for doing this. Everybody, these were part of a collection of stocks that were bought on the January effect trade at HFTAlert.
This particular one wasn't. IONQ,
one.
I don't think was around at the time. So let me bring it in here.
Thank you. And thanks for everybody watching and sticking with us.
So what I'm going to do here is I'm going to bring in the stock, and I'm going to turn off all of these indicators because we don't need them. And all we need to look at is let's see how many bars we've got to go out. Yeah, this is the other company. Hold on.
Huh.
Okay. So when I first found out about this stock, remember this was one came out as a SPAC. Remember the SPAC craze, which is a way that companies have come public. You can see the screen here.
Sure.
Okay, so here's this level is like $8, right? This high here is 36. See how it goes vertical?
Quickly.
And then it trades it out, of course. And then boom, it flattens out. So this is the typical emerging growth stock pattern. When it first comes public, you get a big spike because everybody wants something new. You trade it by selling half your position when it doubles. You put that away and you just let it sit. And there are multiple opportunities to trade. And when it gets down into these kinds of levels, you look to see what your actual cost was. Of course, since it's zero cost, it's all profit. So you see what that level is. And then provided the company is achieving its goals, and very often the company's progression in its business plan is inversely correlated to the stock chart. So like Pulse, for example, if we look at Pulse, which I know very well because I've followed it from the beginning. It's been like 5 years now, I guess.
It got upgraded today, or you said yesterday.
That was the change in the
leadership. That's Pulse.
Well, the same leadership, but he just took a bigger position. Hold on. Let's try 400 bars. And let's try 500. All right, so here's that run up in 2021. Here's $5, right? $6. Here's 46. We traded this a couple of times, and then looks just like the other chart, right?
If the company's not going out of business, how is it that you can't buy this?
When the stock was here a year and a half ago, their business plan was to get to them to a certain point, and they're way past that point now. And look where the stock is. It's way the heck down here. So this is a much better opportunity for people. So we would add to that position and then just, ignore it for a while. Bob Dugan is committed to this company, and their recent press release on the 20th confirms that. He has always funded these companies through rights offerings, which are the fairest of offerings because it enables the investor to really participate as an owner and keep their equity position constant, not accept any dilution. So
Hey, sorry to interrupt. You just mentioned Bob Dugan. Can you just explain to the people listening who Bob Dugan is and what his role in the company is?
well, he was an entrepreneur here in Santa Barbara, and started the company that turned into Intuitive Surgical and developed the product that is now the Da Vinci robotic surgical system, which has enhanced the lives of millions of people. If you have prostate surgery, you're most likely been done on a Da Vinci machine, and how many men's lives have been saved from that device. It's incredible. And then he started another company, PCYC, which had a new type of cancer treatments. And they went through a number of years of challenging times in that getting their FDA filing done. You know, it's one thing to come up with, remember, FDA filings don't tell you whether the drug works or not. It tells you whether your claims are supported or not. And that's some of the issue that they've had with Pulse. But he made billions off of that, and lots of other people plenty of money. That stock is now ABBV. He's invested, owns the majority position in Summit Pharmaceuticals, which is a British company that's working on a drug cure for C. difficile, which is a very harmful intestinal bacteria that kills many people and causes, havoc in your guts. And Pulse Biosciences has a novel pulse stimulation technology that can be used for a variety of dermatological conditions, and as well as cancer conditions. And now they've announced the other day that there are now applications for heart treatments of one kind. I haven't really read any more into that, but has an application in cardiology. And his career has been, I followed him for many years. I followed a number of other very successful entrepreneurs like this who not only provide jobs to thousands of people and create industries, but enhance the lives of millions and millions of people. And capital markets are what make that happen. And many people have this notion that the capital markets are just out there to make the fat cats rich. No, they're out there to make your lives better. We wouldn't be on Zoom right now if it weren't for entrepreneurs.
So what's Dugan's role at Pulse?
I need to read the
He's CEO?
Executive CEO. People should go to pulsebiosciences.com and go to the investor section and look at the news and events.
Thank you. Sorry, I just wanted to get that. He's CEO and he's very successful. And the stock is $1 or $1.50.
Something like that. It's
yeah.
Tremendous. I've made some serious money off of both Computer Motion as well as PCYC.
Yeah, and everybody listening, I highly endorse Steve Hammer and his choices, even though he's a nasty teacher.
And I have a very large position in all of those companies that I've made, and I don't sell them. I only buy them.
Got it. Full disclosure, I have a smaller position in Pulse okay, so next class
starts on the 27th, which is a week from yesterday. As of this morning, we had 15 spots left. We only take 30 students, $550. If you find that our approach works for you, because not everybody does, it's very likely that you will earn far more than the $550 cost of the program by the time the sessions end. I get emails from people all the time that ask me if they can prepay a year's worth of services, and I say no.
And then they need to prepare for 2 or 3 weeks of full-time watching class, right?
It would really be at their disadvantage to not be in the chat room starting at 8:45 in the morning for the opening webinar, to at least noon. in the first 5 days. Very critical. Even though we're only teaching you 3 or 4 concepts, it takes people, because you're so used to filtering the market through the perspective that most of you have. And we have to eliminate that for the moment. You can bring it back in later, but we really like people to come in with an absolutely blank mind. I can teach someone that has never seen a stock chart to trade successfully much faster than someone that has experience trading and is finding it difficult to be consistently successful. And we don't mean every single trade. About 80% of our trades earn their profit targets. And usually,
oh, sorry to interrupt, Steve.
no, go ahead, please, Peter.
Oh, I was just gonna say, it's like learning chords and harmonic structure, and then you could eventually go into the various stylistic rooms and jam with other traders, which is really it's nice for a lot of us. You know, everyone has their own style. I only trade QQQ.
Right.
Percent of the time. There's a room for that. I like the volatility. I like how wild it is, and I'm familiar with the products, with the names in that ETF. So I think that's basically what you're basically signing up for fundamentals, and it may trim away a lot of the fat from watching CNBC obsessively, or like watching Chem Carson on market structure, or obsessing on the Fed, and a lot of the other kind of ways that people trade that maybe are like good entertainment, but don't yield profit margin to some degree. So I think it also helps you decide, hey, am I here just entertaining myself, or which could be emotional entertainment, or it's almost like seeing trading as a sport, but it's a valid way to just make a chunk of change. And also change your perspective about how money flows through markets. It's amazing.
Peter, did you have to unlearn anything?
Everything. I unlearned everything. I'm like a different person now. And I'm not shilling this either. I probably sound like a cult member or something.
I can testify that none of us are cult members. I have personally had disagreements with Steve in the chat, and so.
But do you use it to support or confirm your own trades, Chris?
Say again, Peter.
So you have your own stack, and we should have a happy hour sometime. I'd love to learn more about the stack you use to make your trades. I think it'd be a really interesting contrast or comparison to what Steve's doing.
Yeah, I'm an avid user and supporter of Steve's methods. But as you say, right, like as Steve says, it's much easier to learn from the get-go than to unlearn.
Yeah.
Really hard.
The last thing I'd like to say, and then I need to get somewhere by 2:30. Trading the appropriate security is something very early on that I focused on and asked pretty much everybody individually. I find that many times people get themselves hurt because they're trading the wrong security. And especially if you have small accounts, that's where the real risk comes in, because you're going to be looking for something that's got a lot more leverage to it. So you're going to be attracted to expiring options. And even though we have a strategy for doing that, and Juan and the guys that do and Cynthia that do the lottos, when the delineator is overextended down or up, and days when there's only cycle momentum in one direction or the other, you can do pretty well with those. I've been actually kind of impressed. This is a strategy that Peter Newstein came up with.
That CPI number, those lottos paid huge.
Yeah.
Remember that?
There's a couple of people that are, they'll take $2,000 or $3,000, and if it's up 50% at the open, they'll immediately take the 50%. Then they'll take that full amount, and then they'll do it again. It goes up. If it opens up 100, boom, they're out. But the key there is you exit immediately because it's a lotto. And, if you get a winning lotto ticket, you don't wait to see if the amount that it says you won is going to change. It's going to go up.
I'm sorry to interrupt. For people who are listening, the situation going into that CPI report where we rolled off the table 100 handles pre-open was that the market was overextended to the upside, which had left, and it was time-wise run out of momentum to the upside. So the HFT, and I think, I hope I'm saying this right, the HFT system was only showing the potential for lower momentum relative to the day before, as well as the market had been overextended to a great degree to the upside. So the probabilities there was an asymmetrical probability for downside puts, which were very cheap given that we had this huge run to pay off.
And when Chris says overextended, that's a measured number. When people say the market's overbought or oversold, that's typically an emotional response to the length of time that particular trend had been in place. But when we say overextended up or down, it's a measured amount. It's a value on the delineator itself. And there are periods of time, this is what you'll learn in the second day, is how to calculate cycle momentum in advance. And cycle momentum, we have only two rules. Price follows the slope, and we trade when cycle momentum is high, and we avoid when low. And we show people a very simple arithmetic process to calculate tomorrow's cycle momentum, and that tells us when and in which direction we'll be seeking our setups. So we always know in advance the direction, the magnitude, and the duration of any cycle on the delineator. And when you know those three things in advance, you know the future. And we're not predicting the market, we're predicting the direction that we will be trading setups, because we only trade long or short. We have a lot of people now that have been successful over a period of 6 or 9 months, and they do go long and short. They go short or long against the discipline, and that's fine. That's on the aggressive side because they know what they're doing. That's the point, is that when you stick to the buy the book setups, when you're learning, you'll get to a point where you'll start making money consistently. Your losses will be very low. You'll learn how to trade your way out of a situation. And those three things will result in you being able to come back tomorrow every time, especially after a losing trade. Because as long as you stick to the methodology, it's a market. There are exogenous events. It can go one where something can come out of the middle of nowhere. You never know what those events are when you look back at a stock chart. Someone's got some wavy lines and they say, well, look, it didn't do it there. Look what happened. Well, you know what happened on that day? Was that a Fed announcement day? Did someone get shot in the head? And so there's always going to be periods of time when the market goes against you, and that doesn't mean you were wrong. You're only wrong if you freak out, run screaming down the street in panic, and just as you were wrong if you saw someone putting on their brakes on the freeway and you suddenly went berserk and went over swing the car to the left and went over a cliff, So anyway, I got to get going here. I got to go to
not surfing stock prices.
Right.
Everybody. Right. Thank you, Steve Hammer. Thank you, Peter. And everybody, if you have any questions, you can find anything through Lucci. Peter's are you on Twitter, Peter?
Yeah, but I don't talk about financial stuff. I talk about meditation. I talk about my job, my real job.
And then HFTAlert, of course, Steve Hammer. And if you're really interested, definitely check out the course. It's good.
Yeah, go to HFTAlert.com. Way up at the top on the right, it says Trading School Sign Up. Click on that. It'll go to a page, read the lesson plan link. And if you want to subscribe, there's a button there that says Pay Now.
And I hope everybody survived today. I know it's a Fed day and the market's been gnarly. So we all hope that everybody survived, and the weekend's coming, and we'll be back at it tomorrow. So thank you again for watching. Thank everybody at Lucci for putting it on. Thanks, Stephen.
Thanks,
everyone. Have a good night.